Chris Harvey, Wells Fargo Securities Head of Equity Strategy, and Liz Ann Sonders, Charles Schwab, Chief Investment Strategist, join us this morning. Great to see you guys. Chris, let me turn to you. We were just mentioning some of your chart work of the morning. Actually, the really cool one is about the Senate and why it's important, especially since some of the polling suggests that might be the most certain outcome of the week.
I think so. So everyone asks us, who's going to be in the White House? And when we turn to them and say, listen, you don't need to know who's in the White House, because if you look at who controls the Senate, that's where the favorable returns come from. And a GOP-controlled Senate over a 2-year period, those are some of your better returns. And we think that's because the GOP is more focused on the economy. They're more business friendly, lower taxes, less regulation. And so it's much more friendly to the equity market. And that's the most important thing. The other stuff is just really hard to predict, and I think will come down to the wire.
But you think the historical trend of S&P up 6 months after any election, it still makes sense?
It makes sense. And what we also have is we have a Fed easing cycle. So typically 12 months after the Fed starts cutting, you do see equities up. And so now we have some certainty with the president. We know who's in Congress, and we have the Fed lowering rates. And that's a pretty good thing. As you were talking about, the economy's not bad.
So what do you make then of the moves we're seeing, for instance, today, the reversal of the Trump trade on the dollar and treasuries? I mean, there are things like tariffs, which make this one a little more unique, and you don't need Congress to do.
No, that's true. I think what we're seeing today is just a little bit more uncertainty. Everyone was very positive the Trump trade was going to happen and Trump's going to be in office. Some of the polls that we saw out of Iowa changed that. So you saw the markets tighten up, and we're just we're pricing a little bit more uncertainty. And I think that's what's happening with the rate market. That's what's happening with the equity market.
What if we don't get a result? I mean, that's the other warning that I'm reading in all the research notes of how long it would take to really see a market reaction, how the market would take that uncertainty.
Not good, not good. So if you go back to 2000, I think we're off about 4% in the first couple of days. I think we're down double digits, but by December we had it resolved and equity markets started to go higher. So it won't be good, but it's not clear to me that this is going to be, I think things are going to swing all red or all blue. I think the states are going to be very close, but the Electoral College may not be. I just don't know whether it's going to swing red or blue.
Liz Ann, do you agree with the idea, buy stocks no matter what happens, who wins the election?
Well, I think I totally agree with Chris that if it's a contested election and drawn out, I think that's a volatility driver. I think that's probably the easiest call to make. But I think there ends up being some sort of relief rally in the aftermath of an actual decision. We know there's been a lot of holding off on, whether it's holding off on hiring or holding off on firing or holding off on CapEx. And I think you relieved some of that uncertainty and maybe see a little bit of opening up in terms of the outlooks coming from companies, anything that they were holding off on as a result of the election.
Liz Ann, I remember going into this reporting season, one of the worrying threads was that we were going to start to get some year-end concerns, commentary, qualitative statements about 25. It certainly hasn't been reflected in the aggregate beat so far, right?
Yeah, so you have had a slight trending down in terms of the beat rates, and you've seen a tiny little movement in fourth quarter estimates, which are still pretty healthy relative to where we are in the third quarter. You have seen a big trend up in third quarter. We're running at about an 8% blended growth rate right now versus an expectation of 4% coming into this. But as is been the case for the last few years, I think analysts are sort of keeping the out estimates a little closer to the vest from a time perspective. During reporting season, they might make adjustments to the next quarter, at best the quarter after that, but they're not really moving estimates that much, say, a year out. And I think that's somewhat just due to general uncertainty, but a lot of companies not going back to that kind of precise cents per share 4 quarters out guidance, because more and more companies you're hearing saying that's not how we run our business. And I think that is something that started to happen in the early part of the pandemic when we saw a record-breaking number of companies withdraw guidance altogether. I think they're using that maybe as an opportunity to not go back to that same kind of attempted precision 3 or 4 or 5 quarters out.